Welcome back to the Deep Dive. Today, we're really digging into the recent Q1 2025 earnings call from Newell Brands.
That's right. Management laid out their latest numbers, their perspective, especially on all the big shifts happening with global trade and, tariffs.
Definitely the hot topic.
Yep.
So our mission here is to kind of unpack the key insights, the numbers, the strategic points they discussed.
Exactly. We want to understand their performance, their outlook, particularly with these, external factors swirling around.
Okay, let's jump right in then to the Q1 results snapshot. How did they actually do?
Well, looking at the headline number, core sales, they reported a decline of 2.1% compared to last year's Q1.
Okay, 2.1 down.
Yeah, but, and this is what management stressed, this was actually an improvement, both sequentially, so better than Q4, and better year over year in terms of the rate of decline.
Okay.
It landed right at the high end of the guidance range they'd previously given. So a decline, but maybe a bit better than feared and showing some positive momentum, sequentially at least.
Interesting. So the trend's improving, even if the absolute number is still negative. Were there any particular bright spots within that sales number?
Absolutely. They did call out positive core sales growth in their learning and development segment.
Okay.
And also their international business. That's a pretty big piece for them, about 40% of total sales. It also saw positive core growth.
And how long has international been growing?
That's actually the 5th quarter in a row they've seen growth there. So it seems like a pretty consistent engine for them right now.
5 quarters internationally. That's definitely a solid driver. Okay, what about margins? That's often where you see the impact of efficiency efforts.
Right. And on that front, they had some pretty good news. Normalized gross margin, that's the adjusted figure, it improved by 150 basis points.
1.5%.
Exactly, hitting 32.5%. And what's really notable, this is the 7th consecutive quarter they've expanded gross margin year over year.
Wow, 7 quarters straight. How are they managing that?
They put it down mainly to, a mix of things. Productivity gains in their operations, that's one, and also the pricing actions they've taken over time. They said these efforts were enough to successfully offset the inflationary pressures they're still dealing with.
Okay, so stronger gross margin consistently for almost 2 years now? How did that translate further down the income statement? Operating margin.
Normalized operating margin, again, adjusted, came in at 4.5%, and this actually beat their own expectations for the quarter.
Better than expected, even with inflation.
Yeah, and interestingly, it was better despite them actually increasing their marketing spend. Their A&P, advertising and promotion, was up high single digits compared to last year.
So they spend more on marketing, but still beat on operating margin.
That's right. It seems that better than expected sales performance coming in at the high end, combined with that strong gross margin expansion, really helped pull the operating margin through, even with the higher marketing investment.
That sounds pretty efficient. So what was the final result then? Earnings per share?
Normalized EPS was actually a loss of 1 cent for the quarter.
A loss?
But, and this is key, it was 5 cents better than the upper end of their guidance range. So operationally speaking, they finished Q1 stronger than their own forecasts suggested.
Got it. So sales better than guided, margins strong and still expanding, which led to a smaller loss per share than they predicted. Overall, it sounds like the operational side was pretty solid against their targets.
Yes, I think that's fair. Broadly, they met, or in some cases, beat their own performance bar for Q1 on those key metrics.
Okay. Now let's touch on cash flow. Q1 is usually a bit of a different beast for them, right? Seasonally?
It is, yeah. Q1 is typically what they call a cash take quarter. It's just the seasonality of the business, inventory builds happening then.
And how did it look this year?
This quarter saw an operating cash outflow of $213 million. Now, that compares to a positive flow of $32 million in Q1 last year.
Whoa, that's a pretty significant swing. What drove that change?
Management pointed to a couple of specific things. One was a conscious decision they made to pull some inventory purchases forward.
Why do that?
Strategically, they said, to potentially get ahead of any upcoming tariffs and minimize the impact later on, sort of a pre-buy.
Okay, makes sense. Well,
the other factor was a much higher cash bonus payout this year compared to last year. So those two things, timing and strategic inventory moves, really impacted the quarterly cash flow number.
Right.
They did mention, though, that their actual cash conversion cycle improved year over year, just not as much as it might have without that tariff-related inventory build.
Okay, so the cash flow number itself might not signal operational weakness necessarily. More about specific, maybe strategic choices around inventory timing and compensation. How's their debt situation looking after all this?
Their net leverage ratio basically debt compared to EBITDA, it did improve slightly, down to 5.3 times compared to 5.6 times in Q1 last year. So they are still chipping away at reducing that debt load.
Right. So, summing up Q1. Results generally better than they guided, margins still expanding consistently, cash flow affected by some timing and strategic factors, but debt is slowly improving.
Yeah, I think that captures the Q1 performance pretty accurately.
All right, let's pivot a bit from the pure numbers to the bigger picture strategy. Management said they feel their new strategy is working. 7 quarters in now. But the really dominant theme on this call, the unavoidable issue, was tariffs and this whole shifting global trade landscape. How do they frame that discussion?
Yeah, that was absolutely central. They really hammered this point home. Their core message is essentially that they believe they are in a unique spot to potentially benefit, maybe even disproportionately, from this current environment.
Benefit from tariffs and trade disruption. That sounds counterintuitive.
It does, but their argument is it's because of proactive strategic decisions they made years ago, long before the latest tariff hikes.
Okay, that's a bold claim. How are they backing that up? What were these proactive decisions?
They really focused on 2 main pillars. First, they've been deliberately and pretty aggressively shifting where they source their finished goods, specifically moving procurement away from China.
How big a shift are we actually talking about? Can you give us the numbers?
Yeah, they gave some specifics. So a few years back, finished goods imported into the U.S. from China made up about 35% of their total cost of goods sold, their COGS.
Okay, over a third.
Right. By 2024, that number was down to 15%. And just for context, their total U.S. imported finished goods from all countries combined was 24% of global COGS last year.
So China's down to 15% out of that 24% total imports. Where's the rest coming from?
After China, the next biggest source was Mexico. That accounted for about half of the remaining 9 percentage points. And they made a point of stressing their Mexican facilities are 98% USMCA compliant. Meaning those goods aren't generally subject to tariffs moving between the U.S., Mexico, and Canada under the current trade agreement.
Got it. So this wasn't just a sudden reaction to the latest tariff news. They were already doing this.
Exactly. Management really emphasized this wasn't some panic move. Their plan, even before the recent 125% tariff talk, was already to cut those China-U.S. imports further, down to 10% by the end of 2025, and even lower by the end of 2026. They were already well down this path of de-risking from China.
Okay, so shifting sourcing away from China is piece 1. What was the second key decision they highlighted?
The other major piece is that they've maintained and actually heavily invested in their domestic manufacturing base, mostly in the U.S.
How much investment are we talking?
They cited nearly $2 billion put into U.S. manufacturing since 2017, with a big chunk of that focused on automation.
And what does that investment mean for them right now with all this tariff uncertainty?
Well, it means that over half, more than 50% of their U.S. sales in 2024 were actually manufactured through their own North America supply base. That's plants in the U.S. and Mexico.
Right.
And the critical point there is that products made here or in Mexico under USMCA rules are not subject to these tariffs when they're sold in the U.S. market.
Which big brands are we talking about that they make domestically or in Mexico tariff-free?
They listed quite a few, 8 of their top 10 brands, actually. Rubbermaid, Sharpie, Yankee Candle, Expo, Papermate, Coleman, Ooster, and Rubbermaid Commercial, plus others like Nook baby care items and Balker canning jars.
And the advantage comes because competitors might not have that set up.
Precisely. They highlighted that many of their competitors selling similar types of products do source heavily from China. So Newell's domestic production base potentially gives them a real leg up, a competitive advantage in this environment.
And is this domestic capacity they have actually ready to handle more volume if needed?
Yes, that was another crucial point they made. Thanks to those automation investments, they have significant untapped capacity across their U.S. and Mexican facilities.
So they can ramp up?
They believe so. With other companies and maybe retailers looking for alternatives, potentially facing supply chain headaches or huge cost increases from China due to tariffs, Newell Brands sees their existing, ready-to-go North American capacity as a major strategic asset right now.
Okay, so they've cut their China reliance and beefed up tariff-free North America capacity. Makes sense. How are they actually talking about dealing with the tariffs that do impact them right now? They mentioned splitting it up.
Right. They kind of put the tariff impacts into 2 different buckets conceptually. Bucket one covers the stuff that's been around longer or is less dramatic. Things like existing tariffs related to Mexico-Canada trade, though mostly offset by USMCA, the initial 20% China tariffs from a few years back, steel and aluminum tariffs, and other sort of reciprocal or retaliatory duties from various places.
Okay, bucket one. And what's the plan for that?
For this bucket, management stated pretty clearly they have a plan and high confidence they will fully offset the bottom line impact, meaning no hit to their normalized earnings per share from these bucket one tariffs.
Fully offset. That sounds ambitious now.
They listed several mitigation levers, updated commodity cost savings. They specifically mentioned lower oil and gas prices, helping with things like resin costs and transportation. They're also getting procurement cost reductions from some suppliers in those tariff-affected markets. They're scrutinizing discretionary spending closely, although remember, they are still increasing A&P spending overall.
Right.
Favorable foreign exchange movements have apparently helped a bit too. And crucially, they've put through targeted U.S. pricing actions. 2 rounds, actually. One of already in effect, another just took effect May 1st. So all those things together are expected to neutralize the impact of bucket one.
Okay, so bucket one is essentially considered handled within their existing guidance because they expect to offset it completely. What about the really big one, the recent development, that potential incremental 125% China tariff?
Ah, yes, that's bucket two. And because it's so large and frankly still a bit fluid, they're handling this one separately. It's currently outside of their formal financial guidance range. They're providing sensitivity analysis on it, but not baking it into the main forecast.
What was their immediate reaction when that massive potential 125% increase surfaced?
Their first move was pretty decisive, quite dramatic actually. They paused virtually all outstanding purchase orders they had with Chinese suppliers.
Wow, paused everything.
Pretty much. And they put a moratorium in place on bringing on any new suppliers unless those suppliers either already have or are actively developing manufacturing capabilities outside of China.
Why take such a strong, immediate step?
Their explanation was pretty blunt. For most products hit by a 125% tariff, the price increase needed just to recover that cost would make the item basically unsaleable at retail. Consumers just wouldn't pay it.
Priced right out of the market.
Exactly. They did carve out one potential exception, though, where the dynamics might be different. The baby gear category.
Yes, the baby gear challenge. That seems like a specific sticking point.
It really is. For those impacted products, especially in baby gear, the plan is multifaceted. First, lean on existing inventory. They said they currently have about 3 to 4 months worth of tariff-free baby gear already sitting in the U.S.
Okay, buys them some time.
Right. And while they work through that stock, they are, in their words, aggressively and rapidly developing alternative sourcing solutions outside of China. They're also looking at simplifying their product range SKU rationalization within that category.
And is this just a Newell Brands problem or industry-wide for baby gear?
Management was clear this is a major industry-wide challenge. They threw out some pretty stark numbers, something like 97% of U.S. strollers and 87% of car seats are currently sourced from China. So, yeah, this impacts everyone playing in that space.
Did they talk about any potential relief? Like exemptions for baby stuff?
Yes, they did mention that. They noted that during the previous administration, baby gear products actually got Section 301 tariff exemptions, that's the specific trade law, because they were seen as essential items for families.
So they're hoping for that again.
They confirmed lobbying efforts are underway, both by Newell Brands themselves and the wider industry group. And yes, they expressed hope that the current administration might reinstate those exemptions for baby gear. It's a key uncertainty.
So how much of their baby business is actually exposed to this potential 125% tariff? Can they quantify it?
They broke it down roughly. About 20% of their total baby business is U.S.-made baby care products, like their Newell brand stuff. That part is actually tariff advantaged.
Right.
Another 20% or so is baby gear that's sold outside the U.S., so obviously not impacted by U.S. tariffs.
Right.
That leaves the remaining 60%. That's the portion that is baby gear sourced from China and sold into the U.S. That's the piece potentially hit by the big 125% tariff.
And have they started raising prices on that specific 60% yet.
Yes. They said they've already taken 2 rounds of price increases specifically on those affected baby gear products, totaling about 20% so far.
Not the full 125%, though.
No, not yet. But they did say they anticipate that if this tariff sticks, you'll inevitably see significant industry-wide price hikes on baby gear. And they suggested this could, maybe counterintuitively, potentially benefit their Graco brand.
How so?
Their argument is Graco is positioned as sort of a premium option within mass retail. If all baby gear prices jump significantly due to tariffs, Graco might look relatively more competitive, especially compared to brands potentially even more reliant on China sourcing, who might have to take even bigger price increases. It's a theory anyway.
Okay, so baby gear is definitely a challenge, a point of exposure they're actively managing. But the broader message from management seems to be that this whole trade disruption is actually a potential opportunity because of that domestic manufacturing base they've built. How are they trying to capitalize on that?
Right. This is where they pivot back to those proactive decisions being an advantage. They are now apparently very aggressively going to retailers and basically offering them access to their tariff-free North America manufacturing capabilities.
Especially now.
Especially now during this period where supply from China is expected to be either constrained or suddenly much, much more expensive due to these tariffs.
Does that mean they're offering to make private label goods for the retailers? Like store brands?
No, they were very explicit about that. They are not getting into the private label manufacturing business. Their strategy is different.
Okay, what is it then?
It's to recommend that retailers who might be facing problems with their own China-sourced private label products or seeing competitor brands struggle should consider discontinuing those items.
And replace them with?
And instead, stock more of Newell Brands' own U.S. or Mexico-made branded products. Basically, swap out the tariff-hit private label or competitor item for a tariff-free Newell brand.
Can you give us a concrete example of how that might work?
Yeah, they used their Oster blender plant down in Mexico as a prime case study. It's USMCA compliant, right? So blenders made their ship into the U.S. tariff-free.
Okay.
They've poured money into automating that plant, doubled its capacity effectively, but it's currently only running at about 50% utilization.
Lots of room to grow.
Exactly. Meanwhile, most blenders sold in the U.S. market today are sourced from China or maybe Southeast Asia, places that will face these tariffs. So their Mexico plant offers this ready-to-go source for Oster-branded blenders that completely bypasses those tariff costs. That creates, they argue, a significant potential advantage over competitors and private label options still stuck sourcing from China.
Makes sense. Have they actually seen any wins from this approach yet? Are retailers biting?
Yes, they confirmed they have secured some notable wins already by leveraging this exact advantage. They specifically called out wins in categories like food storage and vacuum sealing bags.
And are those wins baked into their forecast?
Yes. Importantly, they said those specific wins are already factored into an updated financial guidance for the year.
Is that the extent of it, or is there more potential they see out there?
Oh, they suggested there's significantly more potential. They talked about a large pipeline of opportunities, said they're currently in active discussions with retailers across 19 different product categories where they think they have this competitive edge due to their North America manufacturing.
19 categories.
19. And out of those, they said 17 represent potential upside opportunities, meaning business that is not yet included in their current financial guidance.
So these could be additional boosts down the road, but maybe not hitting the P&L right away?
Precisely. They did explain that the potential revenue benefit from winning these discussions is likely to be larger in 2026 than in 2025.
Why the delay?
It just takes time, right?
Yeah.
For retailers to make these kinds of decisions, change their store layouts, their planograms adjust shelving, shift sourcing away from existing suppliers. It's not an overnight process.
Makes sense.
And beyond just the potential for more volume, management also touched briefly on ongoing efficiency gains. They have this continuous improvement program across their factories and distribution centers. They call it PEAK.
Peak. What's the main idea behind that?
Well, it's basically a multi-level program aimed at driving cost efficiency and operational excellence. But the key takeaway they shared, which was interesting, is that none of their plants have actually reached the highest levels of attainment in this program yet, specifically phases 4 through 6.
Why is that significant? What does that imply?
It suggests, they argue, that there's still substantial future runway for continued improvement in both gross and operating margins just by optimizing the operations they already have, getting those plants up to the higher peak levels.
More efficiency gains still to come.
Potentially, yes. And they connected this back to the automation investments, too. Mentioned they've actually reduced supply chain staffing needs by about 3,800 positions over the last 3 years because of automation.
Okay.
So the implication is, as they potentially ramp up production in these highly automated North America facilities to capture that tariff-driven opportunity, the cost to produce each additional unit should be very low, making that incremental volume highly accretive to their overall margins.
So potential for more volume, and that extra volume could be produced much more efficiently, boosting margins even further down the line. Okay, let's wrap things up with the full year outlook. Did they stick with their original guidance for 2025 or make changes?
For the most part, they affirmed the key metrics. The 2025 financial outlook for net sales, for normalized operating margin, and for normalized EPS remains unchanged. And they were clear. That guidance range includes fully covering the impact of those bucket one tariffs we talked about through all those mitigation actions.
Okay, affirmed on the main lines. Was there any change at all to the full year outlook?
Yes, one substantive change. It was to their core sales outlook. They now expect core sales for the full year to decline somewhere between 3% and 1%.
Okay, how does that compare to before?
Their previous guidance range was a decline of 2% to positive 1%. So they've slightly lowered the top end and the bottom end of the core sales range.
Right, a slightly weaker core sales expectation. What's driving that adjustment? Did they lose share? Management was very specific about this. They said the change is solely due to a more cautious view on the overall market conditions and category growth rates. They now expect the categories they compete in overall to be down maybe 1% to 2% this year.
Versus flat before.
Exactly. Their previous assumption was basically flat category growth. So, importantly, they stressed they are not changing their expectation for their own market share performance within those categories. It's purely an adjustment based on seeing the total market size as being slightly softer this year than they initially thought.
Got it. So it's about the size of the overall pie shrinking a tiny bit, not about their slice of that pie getting smaller. What about cash flow guidance for the full year? Any change there?
Yes. They widened the expected range for operating cash flow. It's now projected between $400 million and $500 million. The previous range was a bit tighter, $450 million to $500 million.
Why the wider range, particularly lowering the bottom end? They said this adjustment primarily reflects the higher inventory valuations that resulted from that decision we discussed earlier, pulling purchases forward into Q1 to potentially get ahead of tariffs. That just impacts the timing and valuation within the cash flow statement for the year.
Okay, and the goal for debt reduction by year-end?
They reiterated their confidence in hitting their year-end net leverage ratio target, which is approximately 4.5 times. They see this as a key step on their path towards eventually achieving an investment-grade debt rating, which is a stated ambition for them.
Did they give specific numbers for the next quarter, for Q2?
Yes, they did. For Q2 2025 specifically, they guided for both net sales and core sales to decline between 5% and 3%. They expect normalized operating margin in Q2 to land between 10.4% and 10.8%, and normalized diluted EPS to be between 21 and 24 cents.
Okay, and just one last time to be crystal clear on that big bucket 2 issue, the 125% China tariff. What's the potential hit to their full year EPS guidance if that thing actually persists all year?
Yeah, they put a number around that sensitivity. They estimated that if the additional 125% China tariff were to stay in effect for the entire rest of the year, the total unmitigated impact on their normalized EPS could be around 20 cents.
20 cents, that's significant.
It is. However, they immediately followed that by saying they have already identified mitigation actions, things they can do, where they have a clear line of sight to offset at least half of that potential 20-cent impact.
Okay, so mitigating at least 10 cents of it.
Right. Which means the potential net impact on their current normalized EPS guidance range, which is 70 to 76 cents, could be a reduction of up to 10 cents. And they noted most of that potential impact, if it materializes, would likely fall in the second half of the year.
Okay, wow. We have covered a huge amount of ground here. The Q1 numbers, the whole strategic pivot on sourcing and manufacturing, the different tariff buckets, that's specific baby year challenge.
Right. And then the flip side, the advantage they see in their domestic capacity, the potential for future efficiency gains from peak, and the full year outlook with that tariff sensitivity built in.
It really is a lot to unpack. But you're right, the core story management is trying to tell is actually pretty clear and pretty compelling in its own way.
Yeah, I think so.
So let's connect this back for you, the listener. Why should you care about all these intricate details from one company's earnings call?
Well, I think the story here, fundamentally, is about a company, Newell Brands, that genuinely believes its long-term strategic investments, particularly those maybe less glamorous ones in its supply chain and its manufacturing footprint made years ago.
The boring stuff.
The boring stuff. They believe those investments are creating a really unique opportunity for them right now. They see a chance not just to sort of survive this turbulent global trade environment, but maybe even to thrive in it.
How? By gaining share?
Potentially, yeah. By gaining market share where some competitors might be more vulnerable because of tariff impacts, even while Newell itself is facing its own near-term headwinds, like that baby gear issue and the slightly softer overall market demand they mentioned.
So it paints this picture of management kind of viewing these external shocks, not just as fires to put out, but maybe as a catalyst, something to leverage decisions they made way before this latest crisis even hit.
Exactly. It feels like they believe they were prepared, maybe even unintentionally at first, but prepared nonetheless, to capitalize on what could be a really fundamental, maybe even long-lasting shift in how goods move around the world and where they get made.
This has definitely been a deep dive into how Newell Brands is trying to navigate this.
Yeah.
They're clearly leaning hard into that domestic manufacturing advantage they've built up.
And it really does highlight how those seemingly, foundational, maybe boring investments in things like automating factories or diversifying your supply chain years in advance can suddenly become incredibly valuable, maybe even game-changing strategic assets when external factors just completely redraw the competitive map.
So maybe here's a thought to leave you with. How much does that long-term commitment, a company's commitment to investing in the underlying physical assets, the supply chain resilience, how much does that truly pay off when these unexpected massive external shocks come along and just fundamentally change the rules of the game?
Right. And maybe, is Newell Brands' specific situation here trying to leverage its domestic production when imports suddenly get way more expensive? Could that serve as a kind of blueprint, maybe, for how other companies might look to benefit from insourcing or nearshoring production in the years ahead? Something to definitely keep an eye on as this whole situation unfolds.